Welcome to Whiteboard Programming, where we simplify programming with easy to understand whiteboard videos. And today I'll be sharing with you what is yield farming in crypto and how is it different from crypto staking. So let's get started. Well, first off, yield farming is also known as liquidity mining and is the method of depositing cryptocurrencies into DeFi protocols in order to gain return for rewards which are generally paid in crypto. Examples of this include Compound and Uniswap. Depositing crypto into DeFi pools is known as providing liquidity, which makes you a liquidity provider. Further, to help you better understand what is yield farming, let's first get familiar with a few important terminologies. Number 1. Yield. On its own, the word yield means to produce. For instance, a carrot plant yields carrot at the harvest time, and in context to yield farming, the crypto you deposited into DeFi protocols yields a return paid in more crypto. Number 2. Farming. So, the pools and protocols wherein you provide liquidity are a lot like farms. You plant your seeds, that is, provide liquidity, then let them grow over time into fruit-bearing plants, which proportionally means allowing your deposited crypto assets time to generate yields or profits. Number 3. Liquidity. DeFi protocols like Uniswap, Sushi, and Compound are decentralized exchanges that depend on having crypto assets on hand for people buying and selling or borrowing and lending crypto from one another. Here, liquidity refers to having those assets on hand. The more liquidity a DeFi protocol has, the better price discovery and overall experience it can offer to its users. Number 4. Mining. In the DeFi world, mining has a similar meaning to farming. In that relation, it is used when you provide liquidity to earn rewards in the protocol's native token. For example, if you earn Compound by depositing USDC on Compound network. You are mining Compound tokens by providing another token the protocol needs, which in this case is USDC. Number 5. Liquidity pools. It is basically a smart contract that contains funds. As in return for providing liquidity to the pool, liquidity providers get a reward. These incentives can be percentages of transaction fees generated by the underlying DeFi platform, interest from lenders, or a governance token. Number 6. TVL. In some sense, TVL is the aggregate liquidity in liquidity pools. It is a useful index to measure the health of the DeFi and yield farming market as a whole. Also, it is an effective metric to compare market share of different DeFi protocols. A good place to track TVL is DeFi Pulse, wherein you can check which platform have the highest amount of Ethereum or other crypto assets logged in DeFi. This can give you a general idea about the current state of yield farming, and naturally the more value is logged, the more yield farming may be going on. It is worth noting that you can measure TVL in Ethereum, USD, or even Bitcoin, wherein each will give you a different outlook for the state of the DeFi money markets. Also, do note that yield farming is typically done using ERC20 tokens on Ethereum, and the rewards are usually also a type of ERC20 token. Further, as long as yield farming process is active, users will accumulate rewards. From the perspective of DeFi platform and applications, the main objective of yield farming is to attract liquidity by rewarding investors who are willing to lend their assets. The platform can redistribute those crypto assets to customers who are interested in using their products and services. In the end, a portion of the fees gained from user transactions is used to repay yield farmers. Since DeFi is decentralized, services like yield farming are automated via smart contracts, which means that there is almost no risk of losing your assets since developers cannot manually steal your crypto or transfer them without your permission. Next, let's discuss about how does yield farming work. Well, the concept of yield farming is closely related to the model called Automated Market Maker or AMM, and typically involves liquidity providers and liquidity pools, and let's see how it exactly works. Here, liquidity providers deposit fund into a liquidity pool. This pool powers the marketplace where users can lend, borrow, or exchange tokens. The usage of these platforms incurs a fee which are then paid to liquidity providers according to the share of the liquidity pool. This is the foundation of how AMM works. Here, the rules of distribution will all depend on unique implementation of the protocol. The bottom line is that liquidity providers get a return based on the amount of liquidity they are providing to the pool. Here, the funds deposited are commonly stablecoins pegged to USD, though it is not a general requirement. Some of the most common stablecoins used in DeFi are DAI, USDT, USDC, BUSD, and a few others. Some protocols will mint tokens to represent your deposited money into the system. For example, if you deposit DAI into Compound, you will get CDAI or Compound DAI. Similarly, if you deposit Ethereum into Compound, you will get CEther or Compound Ether. As you can imagine, there can be many layers of complexity to this. You could deposit your CDAI into another protocol that mints third token to represent your CDAI that represents your DAI, and so on and so on. And just like this, these chains can become really complex and hard to follow. But yes, if you do it well, you are sure to earn decent profits. This boils us down to the next question. How are yield farming returns calculated? Now, typically the estimated yield farming returns are calculated annualized. This estimates the return that you could possibly expect over the course of a year. Some commonly used metrics are annual percentage rate or APR and annual percentage yield or APY. The difference between them is that APR doesn't take into account the effect of compounding, while APY does. Compounding in this case means directly reinvesting the profits you generated for more returns. It's also worth keeping in mind that these are only estimations and projections, and in some cases even short-term rewards are quite difficult to estimate accurately. Why? Because yield farming is a highly competitive market and fast-paced as well, and the rewards can fluctuate rapidly. If a yield farming strategy works for a while, many farmers will jump onto the opportunity and it may stop yielding high returns. Lastly, the exact reward amount is determined by calculating metrics like APR or APY and the interest rate that changes along with the pool activity and, of course, the token value. Due to this fast-paced nature of DeFi, weekly or even daily estimate returns may make more sense than the long-term ones. Seems promising, right? Well, it is, but there are still yield farming risks involved, and they primarily stem from the poor smart contract coding practices. If a project isn't audited or if a team member unintentionally creates an exploitable smart contract, anyone with sufficient technical knowledge can steal your funds. For example, a lending protocol might use its users' fund to fund flash loan services, and if this flash loan smart contract has an exploitable attack, John, a hacker, can effectively create loans and not repay them. Millions of dollars can be drained from liquidity pools within minutes. And unless a developer notices the exploits early on, the team will be unable to recover funds, which may result in losing assets that a yield farmer provided initially. And further, if you are planning to venture into this, do note that yield farmers are constantly exposed to this form of risk. Next, you should also know about something called as impermanent loss. It is another risk unique for yield farming. But in this case, the risk isn't tied up to security, but instead, impermanent loss occurs when a cryptocurrency suddenly experiences a gigantic spike in volatility. Here, if the asset rises in value, the yield farmer would have made more profits by simply holding the token. Likewise, the loss is also suffered if the investment declines in value because the yield rate is not high enough to offset the losses. Now I believe that you can understand impermanent loss as very similar to the concept of opportunity cost. And although yield farming generates passive income, users who farm must always think about whether it's a better idea to sell the asset or store it to speculate profitability. Next, let's discuss about what is collateralization in DeFi. Typically, if you're borrowing assets, you need to put up collateral to cover your loan. And we all know that this essentially acts as an insurance for your loan. Well, how is this relevant? Well, this depends on what protocol you're trying to supply your funds to. But you may need to keep a close eye on your collateralization ratio as well. Because if your collateral's value fall below the threshold required by the protocol, your collateral may be liquidated on the open market. You must be thinking now, hey, what can I do to avoid liquidation? Well, one thing that can be done is to add more collateral. To reiterate this, each platform will have its own set of rules for this. That is, their own required collateralization ratio. In addition, the complete concept commonly works with the notion of over-collateralization. This means that borrowers have to deposit more value than they want to borrow. Why? To reduce the risk of violent market crashes, liquidating a large amount of collateral in the system. So now let's say that the lending protocol you're using requires collateralization of 200%. This means that for every $100 of value you put in, you can borrow $50. However, it is usually safer to add more collateral than required to reduce liquidation risk even more. With that said, many systems will use a very high collateralization ratio, which goes as high as 750% to keep the entire platform relatively safe for liquidation risks. Further, some of the most popular yield farming platforms and protocols that yield farmers use include Compound Finance, MakerDAO, Synthetics, Aave, Uniswap, and Yearn Finance. Lastly, let's discuss the difference between staking and yield farming. Fundamentally, crypto staking involves a validator who locks up their coins in the network and waits to be randomly selected by a proof of stake protocol at a specific interval of time to create a block. So, when yield farming and staking are compared side by side, staking usually involves investing good amount of crypto on network to boost the chances of being selected as the next block validator. And depending on the coin's maturity, it can take a couple of days before the staking rewards come by for collection. In contrast, yield farmers move the digital assets more actively from time to time to earn new governance tokens or smaller transaction fees. Unlike staking, yield farmers can deposit multiple coins into liquidity pools across several protocols. For example, yield farmers can deposit Ether to Compound to mint C Ether or Compound Ether, and then consecutively deposit it into another protocol that mints third or fourth tokens. So you can say, compared to staking, yield farming is more complex and the chains can be hard to follow. And though yield farming has a higher return rate, it is also riskier. With that, I hope this video was helpful to you and served value. If you love my content, feel free to smash that like button, and if you haven't already subscribed to my channel, please do, as it keeps me motivated and helps me create more content like this for you.